This is an update for the S&P 500, and also I'll be going to the US macro picture for the first quarter of 2024. Before I start this video, please remember I do these just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. So to start off by looking at the 10,000 foot view for the S&P 500, and we can see we had the classic boom and bust cycles of the dot-com bubble, the credit crisis, and then more recently the FANG bubble. But what is clear is we had this certain gradient at which the S&P 500 increased in value, and after the credit crisis and the beginning of new Keynesian economics, characterized by zero interest rates and severe money printing, we saw an increase in this gradient by which the S&P 500 increased in value. Actually, since the Wuhan outbreak, which led to all kinds of money printing by the US government, we actually have now seen this gradient increase again in its steepness. And although this trajectory can look a little crazy and unbelievable at this time scale, if you look at how GDP has increased in the US at a similar time frame, and also look at the M2 money supply, which seems to be regaining again this exponential curve trend, actually maybe it's not so crazy. And here, where I've collated different macro data sets, we can see how through the new Keynesian economics policies, and particularly with the money printing, we can see that in 2008, 2009, GDP and the S&P 500 along with it have been elevated by this behavior. Also, we see how following the Wuhan outbreak, again, we see an acceleration in GDP and the S&P 500. Now, this slide is from my previous quarterly update I did. And at that point, I felt that it looked like we could return to the long-term trend line. So that's this line here. And although I thought that may gauge up a little bit, I was expecting that to be the baseline. I've noticed this asymmetric triangle, and I was expecting us to kind of bound within this before continuing with this trend. However, what happened was we actually burst to the upside of the asymmetric triangle, and we've now even beaten the previous all-time highs of 2021. So this potential new trend line, which I traced out here, you might just be able to see it here, which was like only a possibility to me back then. It now does look like we're on this incredible new gradient, the all hell new Keynesian economics gradient. And this for me is the kind of base case for what the S&P 500 is doing. The blue line here was what I thought it was going to do at the beginning of the year. And in December of last year, I opened a position with 6% of my portfolio into the S&P 500. And I was expecting the all-time high to act as a kind of resistance before the US presidential election, being the kind of catalyst for us then to continue in this vein. But we've actually well exceeded my expectations here, where with the S&P 500 where it currently is. And as long as we're obeying this trend, there's really not actually much for me to think about in terms of closing that position. Now, before I start going through my macro data, there are two reasons I could give for why the S&P 500 is doing so well. One is the tremendous hydrocarbon wealth of the US, whereas many other areas in the world, so Europe, for example, are now living like energy peasants. The US has tremendous hydrocarbon wealth. It's doing a lot of fracking. and creating a lot of value from its vast hydrocarbon resources, and is a net exporter of hydrocarbons. So this in itself is a good reason for why the US is doing so well. Another is the dominance it has of the best stock sectors. So when I look at my own stock market, which is the FTSE, we see that it's made up mostly of second world businesses. So these are things that were at the forefront 100 years ago, which are now kind of second world enterprises. So we have lots of oil stocks, lots of pharmaceutical stocks, banking, commodities, consumer staples. So really, we have a second-rate economy. The S&P 500, however, has the likes of Apple, Microsoft, Google, Amazon, and Nvidia. And these are the cutting-edge, most advanced kind of businesses who have the ability of generating revenues all over the world. There's no corner of the world which isn't being exploited by these companies in terms of making money out of people. So actually the S&P 500 does have the best kind of businesses there are in the world. So again, that's another reason that can explain why it's doing so well. However, of course, the macro environment could have a nasty impact. So I like to monitor that. And here's my dashboard. And my general premise is that, like I touched on before, the US government and its central banks are using the current global capitalist doctrine of New Keynesian economics, by which obviously the US dollar is the reserve currency of the world due to the military strength of the US and the fact that it rules the waves basically around the world. And in exchange for the free trade around the world, which the US allows, that means that the US dollar is a reserve global currency and has a lot of strength. And this allows them to do things like lots of extreme money printing or quantitative easing, and having perhaps artificially low interest rates because of this global dominance position of the US and how it is the linchpin really of global capitalism. And so through the New Keynesian economics doctrine, the US government can have low interest rates, or it can at least modify its interest rates, and it can embark on huge money printing. Plus it can have certain amounts of socialist government spending and all kinds of money handouts in order to control the government objectives of having 2% inflation, 2% GDP growth ideally, and low unemployment. Now, starting off with, I guess, the most important thing, which is the integrity of the US dollar, and that's what's actually supporting all this. Well, actually, the US dollar is looking relatively strong recently, and this is despite the government debt currently being 122% of GDP, and it running a fiscal deficit of 8% of its entire GDP per year. And here we can see the national debt and how it's just snowballing, apparently out of control. And here we see the deficits for this fiscal year so far, and how actually it looks like, comparing with these COVID years, we are actually, it looks like this amount of debt and fiscal indiscipline is the new normal, is what we see here under the Biden government. But actually, when I plot the US fiscal deficit against going back to 2019, we see that actually it's not that bad, relative speaking, to these previous years, with 2019 representing a kind of quote-unquote okay year. And also the fiscal indiscipline, it's much worse, but it's still, relatively speaking, seems under control. So really, in terms of the US dollar, which underpins all this, I'm not actually particularly worried at the moment, even if the numbers look scary. When you look in a kind of relative sense, it doesn't appear out of control at the moment. Now, the other thing, of course, is yield curves, and a lot of noise being made about the inverted yield curves. Now, how I get to these numbers, I'll go to in a moment, but my general outlook for inflation is that it's a bit on the high side, and GDP growth is just ridiculously strong at the moment. So based on that, my expectations are that there won't be drops in interest rates in the US. And what will happen is actually, so there might be drops, but only small drops down to say 4%. And then we'll see the long-term rates going up. And so that's how I'm expecting us to get to a normal yield curve. Here's the Japanese yield curve, which is a normal yield curve. The US has a inverted yield curve, but I think it gets back to a normal one through going back to having the what is the long-term normal of having kind of interest rates at about what they are now. You know, they might drop a percent in terms of the base rates, and then it might go up a bit in the longer term. And I think that's how we get back to normal, not through a massive currency collapse or what some people might be predicting. So back to the main macro factors, and in terms of inflation, I don't like using the year-on-year inflation. I don't find that very useful comparing with a year ago. I like to go on month-on-month CPI data. Now the problem is that for January we've only got one data point, which extrapolates out to a 1.5% quarterly number. So bear in mind that this is just for one data point, not the normal three. And it looks a bit cloudy at the moment. I mean, the trend's been going down, and there were people talking about deflation even and things, but I think we need to wait for February and March for this to play out. I'm kind of expecting a bit lower inflation in terms of CPI quarterly than here, but still probably a bit on the high side. But really we have to wait. It's kind of muddy waters at the moment. But based on my calculation, which I outline here, I'm currently guesstimating a 3.7% annual number based on what's happening at the moment. So I'm placing inflation as a bit on the high side. It's meant to be 2%. It's actually more like something between 2 and 4%. And so that's why I don't think the Fed will be reducing interest rates, or if they do, it won't be by much this year. Now, in terms of GDP growth, well, I've got this data from macrotrends.net, and you can see that normally GDP growth shouldn't really be getting above 4%. And actually, in the kind of ideal situation we were in the 20 teens, it used to be around 2%. And to my understanding, about 2% annually is the sweet spot. But what we've seen is since the COVID debacle, absolutely ridiculously high GDP growth rates. There was a bit of an upset in 2022, but then last year, the year-on-year GDP growth was ridiculous at well over 10%. And currently, according to GDP Now, which you can see there, that data here, the GDP Now estimate has GDP growth at about 3% for this quarter, with the blue chip consensus being around, let's say, 1 to 2%. So this number is too high, really, I think, particularly in the context of inflation. And so that's how I have it on my dashboard here, that inflation is muddy waters. but it still looks a bit too high. And GDP growth is just ridiculous at 14%. So this kind of underpins my personal belief that we won't be seeing rate cuts this year very much. Then, of course, unemployment is one of their targets, and that's actually very low at 3.7% at the moment. So, on the one hand, there is cause for anxiety. We have the unstable yield curve for the US, which could foretell a number of scenarios. We have an uncertain inflation picture, and we have this trend of ridiculously out of control GDP growth in the US, which hasn't abated. 2% is normal for the year. We're looking at 3% just for the first quarter. So there is definitely room for caution. But at the same time, from this data here, I really can't see the wheels falling off at the moment. And this kind of overheated economy does support the craziness that we're seeing in the S&P 500. And so whilst on the one hand, I wouldn't be comfortable with more than 10% of my own portfolio invested in the S&P 500, I'm still very happy to be invested in the S&P 500 based on those reasons given. And my base case at the moment is that we are going to be continuing on this all hail New Keynesian economics trajectory. The way I look at it is that when you look at the M2 money supply, this is a clearly unsustainable pattern in the long run. Same for the long-term GDP in the US. However, the politicians, and that could be Donald Trump just as much as Joe Biden, they only have the incentives to keep on printing money to keep themselves elected, just like Mark Farber's been saying for many years. Unfortunately, the world we live in is one where the old and the rich are just consolidating their wealth at the detriment of the young and the poor, because ultimately these are the people who are going to suffer from inflation in the long run. But even though this here looks like a petri dish and the population's going to about to die out very suddenly, if you remember your science lessons at school, well, here I've got the long-term GDP graph, and although we do look like we're approaching the death phase, actually, if you change the scale like this, you could see that actually this could continue in the same exponential pattern, for a good 10 years before the actual numbers become so incredulous that the whole system collapses. So although there are all these other factors to keep track on, I am actually expecting this trend to continue, probably more like 5 to 10 years, if indeed these assertions are correct. And this, I'm afraid, is the sad world that we're living in, where the old and the rich are acting irresponsibly to the detriment of future generations. So that completes my video. And if you like the slides, you can go and look at my Twitter account, which is @MarkAlpenblick, where I'm going to share these slides. So I hope you found this video useful, and I'll speak to you at the next one.
I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.